Hi everyone, my name is piterpakulski, and today it's time for us to make a final video for hotel financial model. I will go through the model and see and review all the inputs that you can adjust, what this model is capable of, and I think you can use this model to calculate your business idea. If you enjoy this model, you can download it. I will give you the link to download this model in the description of this video. Also, I will give you all the links to the videos of the process of creation of this financial model, so you can create this model yourself. The basic rule is that all our inputs are colored with blue, a specific color. All other cells are automatic. And we start with setting up the first year when we start our investment stage. So this is the first input. Then we assume that we have different pricing intervals inside the typical year for our hotel. And we set up, we can just name these intervals and set up the dates when each interval starts and each interval ends. So this is the moment when each interval starts, and this moment when each interval ends. So we take the typical year and divide it into the different time intervals. Some intervals may for example be 1 day or 2 days. For example, it's just a holiday when the pricing are high and the occupancy is very high. So we can just create many price. So this is one of the first blocks of inputs when we create time intervals, so pricing intervals, occupancy intervals inside the typical year. What we will do now, then we take different room types. We just name different types of rooms that we have. For example, suite or 1 bedroom, 2 bedrooms, I don't know. So you can name them. Then we have a specific button, switch on and switch off each type of room, so we can see the financial efficiency, the payback period of the diagrams with or without this or that type of room. For example, if you want to make some scenarios to see what is the influence of this or that type of room on the financial efficiency or the payback period. So you can adjust, you can create a coefficients for the pricing for each type of room to create some additional scenarios. For example, the basic value of each coefficient is 100%, so it's basic scenario. But for example, you want to increase or decrease the price of this room or this room, and see what will be the financial efficiency in this or that scenario. And you can quickly different scenarios without adjustment of huge amount of data. So this is the coefficient, the basic coefficient for pricing. Then you just set up the amount of rooms for each type. So this is the amount of rooms for each type of room. It is here. Then we have the similar coefficient for room types. For example, you've created some scenario and you see that payback period is very long, and you want to see, for example, if you can't change the price, you would like to see, if I increase the amount of rooms, what will happen with the payback period. And you just can add a coefficient. For example, if you will just assume that if the room type 10 will be not 14 but for example 42, let's assume that, what the payback period of our business idea. So you can just create a new scenario without adjustment of date and see what will happen if the amount of rooms is growing or it is decreasing. So you just go back, set it back, you set up the direct cost per day per each type of room. Then you have the same coefficient for direct cost. For example, you can just create a scenario and say what will happen with my business idea that if direct costs will rise, for example, up to 50% or decrease on 10% on or whatever. So without adjusting these numbers, you can just use coefficients. So it is very convenient when you create lots of scenarios of operating activity. Then you go with pricing. So in this table, here we have all our time intervals inside the typical year, and here we have all our room types, and specify the price per day per each room type inside each time interval. So you can directly specify the price for the interval, which can be 1 day or 2 days, just a holiday. You can just specify all prices for all types of room per day inside different time intervals inside the typical year. So here is the pricing table for all room types inside inside all pricing intervals. The next table is similar, but it deals with occupancy. So here we have intervals inside the typical year, and here we have different types of rooms, and in this area we specify the occupancy for each type of room inside time interval inside the typical year. Then we set up the year and month when we get the first revenue. Then from the moment when we start the first year revenue, when we get the first revenue, we can assume that we won't get the maximum of revenue and the maximum of occupancy that we assumed here just for the first month. And we can say that we will, at the first month when we open our hotel, we will get just 10% of what we assumed here in this table. So this will make us see the amount of financing more correctly to start our business idea, because we will be able to see the operational losses during the first, for example, 2, 3, 4 months when we get the break-even point. So here we can adjust the pace that we achieve the planned revenue. For example, the first month will be just 10% of our planned revenues, then we go up, and in the result we get the 100% of the revenues that we have. So during the first 2 years, we can monthly adjust the step of reaching that we've created. This allows us to see more accurately the amount of financing that we need, because you will be able to see the operational losses that occur. Let me just move to the cash flow statement to show you, because we've created this table. This table made us see. I will just go the cash flow statement and show you what we are fighting for. We're fighting for this moment, because when we get only 10% of the revenues, we have operation losses here, here, and here at the first month, 3 months when we start operating activity. And this means that we need some additional financing, and if we don't have this table, then we won't be able to see the right amount of financing that we need. So here you can adjust the pace of achieving the planned revenues. Then we have our investment plan. It is automatic. Then we have our investment plan. It is automatic. This is the moment when we start our activity, and from this moment to the past, we just describe when and how much we need financing for this or that investment items. So here we just describe construction works or another types of construction. Here you just type the investment items. Here you specify how much money you need for this or that investment item, when you need this. This is the chronology, this is the place, the area where you specify the inputs. Here you just name what you invest in. Then we go to the payroll. Then you name, here you can name all the positions. Here you specify the salary of one person on each position per month. And then you have a typical year from January to December, where you specify the amount of people inside the typical year on each position. So the business may be seasonal, so the amount of people in each position can be also seasonal, can be flexible. Then you can also specify fixed costs. So here you can specify the names, set up the names of fixed cost items. Also, you have here a typical year where you can set up the values of this or that fixed cost item. So they also, despite of their being a fixed cost item, they can be some seasonal fluctuations. So you can use this table to assign seasonality to this or that fixed cost item. Then you can add a loan. Here you just type the year when you get this loan, the month, the amount of the loan, the interest rate, the long term, the grace period for principal payments, the grace period for interest payments, and this loan will be added to our cash flow statement. Then we specify the rates of taxes. You can adjust the revenue tax, salary tax, profit tax, asset tax. And then we move to the cash flow statement, where we are able to see the amount of equity we need plus the loan that you've entered here. Here you can see the totals. I will go here, for example, when the project starts. So here we can see all the revenues, where you can see the details of revenues. You can see all direct costs, all fixed costs, all payrolls, all taxes. Here is our operating profit monthly. Here you can see the investment stage. You can also click apply to see the details. Then you can see you can add your equity to fight with cash gaps, but in this case the model is completely automatic and you don't have to add manually equity to the cash flow statement. Here you're able to see the cash balance to the end of the period, to see how your project spends money. So for example, this is the moment from the beginning, from the very beginning, when the project spends its financing. So here it spends, then we have mathematical zero, and then the project starts growing. So this is the moment when the project starts generating its own cash flow. And then after cash flow, we can calculate and see the total amount of financing, equity plus loan. You can see the totals. You can create simple and discounted payback period diagrams. You can also simple and discounted payback period diagrams. Here you can see the final financial efficiency, simple payback period, discounted payback period, net value, net present value, profitability index, internal rate of return, loan needed, equity needed, total financing needed. Then we decided to place simple and discounted payback to a separate sheet. Then this sheet is for internal rate of return calculation. Here we just set up the discount rate. Here we set up the pace of adjustment, the discount rate, to find the internal rate of return the moment when NPV goes negative. This is this moment. This value goes to the model. Financial efficiency goes here. Then we just created a simple table to make us see all the revenues monthly, all the expenses monthly, the profit monthly, profitability monthly. Then we've created a simple lines for simple and discounted payback period diagrams, which will appear in this spreadsheet. Then we've created a separate sheet for sensitivity analysis, and we just can add the parameter of sensitivity analysis to any of input input inside our financial model. For example, let it be I will take financing. I will go to investment plan.
I already did that at the previous video.
When we, for example, this is how the inputs look when we just specify them. It's then we just add the equal. Then we go to sensitivity analysis. Then we type like this. Now we've added this coefficient for sensitivity analysis for investment. Then we go to sensitivity analysis block. We just can do like this. Then we press send button, and sensitivity analysis starts, and he will just take the information from the model, add this coefficient to investment plan, and show us the efficiency when the investment will be 10% of what we have today, then 20% of what we've entered at the moment, 40%. This will be the current value of investment plan, or for example, if the investment will grow, on what will be the financial efficiency. So the Microsoft Excel will test the financial efficiency if the amount of investment will grow or decrease, and we'll be able to quickly see the financial efficiency if the amount of investment is growing or decreasing. So we just have to wait until he tests the influence of increasing or decreasing of investment on our model. Then we can delete this coefficient from investment plan and add this coefficient to some another input. Just let him finish with testing investment, and then we will just add the coefficient, for example, to pricing. So now we can see that if our the amount of investment is growing, then the payback period is getting longer, then for example we can change the pace of adjustment. We can go to the model. We can delete the coefficient from investment. Then we go to the pricing, or for example to the amount of room. That will be faster for us.
I want sensitivity coefficient to all of room times. I will just go back to sensitivity analysis.
Then I will just press sense button. So after we finally did it, we can delete this coefficient from this data, add this sensitivity coefficient to some other input data, then press sense button and see how the financial efficiency is changing when we adjust this or that, any input of data. And I think you can use this financial model to test your business idea, your hotel. If this video, this model was the process of creation of this model was valuable for you, you may give us a like, you may subscribe our channel. Also, you can share this video with your friends. We can also create unique financial model for your business idea. We will continue creating different financial models from scratch. I will continue sharing my experience with you, my friends. See you next videos. Thank you and bye, guys.